Welcome to today's explainer. Today we are completely ditching those ultra complex financial strategies. We're not talking about sudden windfalls, rich inheritances, or trying to perfectly time the stock market. None of that. Instead, we are looking at one almost embarrassingly small, incredibly simple decision. We're going to look at exactly what happens when you commit to something so minor it barely even registers on your radar. Yet, it has the power to entirely change your financial identity. Okay, let's dive right into this. What actually happens if you invest exactly $100 every single month? I really want to focus on this specific amount because let's be honest with ourselves. $100 is the amount of money that just disappears over a weekend without you even noticing. It's the amount you spend on things you literally cannot even name by Monday morning. It just kind of feels too small to matter. But then again, sometimes it feels a bit too tight to spare. But what if we channeled that exact, seemingly insignificant amount into a machine? So this journey doesn't start with some perfect master plan or months of obsessive research. Overthinking is exactly what kept you from starting last year, right? Instead, it just starts with an automatic transfer and a basic index fund. You finally click confirm. And you know what happens? Absolutely nothing spectacular. The account shows your $100. Maybe the market moves, 0.3% that day, and your $100 becomes $99.70. You obsessively check that balance 3 times before bed, expecting some kind of magic. But nope, it just sits there. Now, looking at the beginning of this journey, I really need you to understand something absolutely crucial. The first 6 months, they are not a story. They're just a habit. You are feeding this account kind of like a houseplant you're not entirely sure is even alive. Some months it goes up, some months it goes down. You're basically building the muscle of consistency in a gym where the mirrors don't show any progress yet. It is slow, it is highly unrewarding, and honestly, it is entirely mundane. Okay, so you're 6 months in and your balance reads exactly $578. You knew the math before you started. You knew it would be right around there, but $578 is definitely not life-changing. It's not a number you're going to brag about at a dinner party. And this right here, this is the exact gap where most people quietly exit. They don't dramatically quit, they just skip a month because things feel a little tight, and then they stop logging in. They exit because nothing visible is rewarding them. But you don't exit. All right, let's look at year one. You've put in $1,200 and your balance is $1,312. The market cooperated and you gained a grand total of, drumroll please, $112. You could have literally earned that in a single afternoon of overtime. So the crucial point is the real foundation you've built here has absolutely nothing to do with the math. The hidden return is that you built a real relationship with delayed gratification. And more importantly, you discovered that this $100 was not load-bearing in your budget. You proved to yourself 12 times over that your month didn't collapse without it. And honestly, that discovery is far more valuable than $100 in market returns. But then we hit year two, and, well, reality strikes. The market drops. Because, of course, it does. It drops 14% over 11 excruciating weeks. You have to sit there and watch $380 just evaporate. Your account goes from $3,100 down to $2,670. You feel that drop in a very specific, incredibly uncomfortable place, right in the pit of your stomach. But you sit with it. You don't sell. You let the automated transfer happen anyway because the schedule does not negotiate with market conditions. This drop, it actually forces a major psychological transition. See, there is a massive difference between checking your account out of fear and checking it out of curiosity. The investor who checks from fear is actively looking for a disaster. The investor who checks from curiosity is watching for growth. Both investors are holding the exact same index fund, but they are having entirely different experiences, and they are going to make entirely different decisions during a market drop. And by not selling, you have officially transitioned to curiosity. And because you stayed curious, because you didn't panic, look what happens. The market recovers 8 months later, and your account is sitting at $3,900. Those shares you bought right on schedule during the drop, they're now worth way more than you paid for them. The discipline of those down months compounded quietly in the background. You didn't change your behavior, and the machine totally rewarded you. Okay, let's step into the next era of our timeline here. We're looking at years 5, 10, and 20. The gap between what you actually put in and what you now have is widening, and it's doing so faster and faster. The returns are going to stop feeling like a cute little bonus and start feeling like a second contributor is suddenly putting money into your account for you. And that second contributor is time. Time never misses a contribution, and time absolutely never panics.
So you are 5 years in, 60 months of those $100 transfers. Your total out-of-pocket contributions are $6,000, but assuming a historical 10% S&P 500 average, your balance is sitting at $8,200. You suddenly have $2,200 more than you actually put in. You survived a correction, you survived the very real urge to pause your transfers, you now have more cash saved than most people, purely because you maintained a habit through periods of absolute mind-numbing boredom.
Now, people are going to tell you that 8 grand is nothing in the context of long-term wealth. And technically, yeah, they are correct. It's not a house down payment. It's sure not retirement. But they are completely wrong about what it actually means. Because $8,200 is not the number. It is the proof. It is undeniable proof that you are the kind of person who feeds the machine. You can literally build something from almost nothing. Your entire relationship with money and with patience has completely changed.
Jump with me to year 10, 120 months. You've contributed $12,000, but your account is at $20,500. You have $8,500 in pure gains. This is a massive milestone. In an average year now, the market is returning the equivalent of $140 a month on your balance. Remember, you're only putting in $100. Your portfolio is actually growing faster than your own contributions. Your money is literally making its own money.
Think about what you didn't sacrifice to get here. You didn't move back into your parents' basement. You didn't take on some grueling second job. You just made one small, completely non-negotiable decision every month. And 10 years later, that habit is permanent. In fact, permanent habits don't even feel like habits anymore. They feel like a personality. You've quietly separated yourself from all those people who are constantly waiting for the perfect time to start.
Okay, you are now 20 years in. You've contributed $24,000 in total. Your balance is approximately $76,000. Now, what's really interesting about this is the massive gap here. You have $52,000 more than you contributed. The gap is literally more than double your total investment. And you didn't do anything extraordinary. You didn't miraculously pick the perfect stock or get a surprise inheritance. You just let compounding do exactly what it does when you leave it alone. But hold on. Because we are leaving linear growth behind completely right now. We are officially entering the explosive, exponential phase of this machine. Decades 3 and 4 are where the math gets absolutely wild. And that acceleration that has been building so quietly beneath the surface, it finally takes over. Year 30. You've put in $36,000 over the years. Your balance? It's $227,000. But here is the most staggering part of this whole thing. Your account is now generating roughly $22,700 annually. That is nearly $1,900 a month in income generated from literal pocket change, and you don't even have to touch the principal. And this brilliantly illustrates the sheer power of time. Let's compare this. Back in year 1, the market gave you a measly $112 for your trouble. In year 30, it is handing you $22,700 every single year, and you are still only putting in $1,200 a year. The machine has officially become the primary contributor. You are just a passenger, enjoying the ride, all because of a random Tuesday evening decision 30 years ago.
Which brings us to the real climax of this journey. Year 40. 480 months of stubborn, boring, totally unstoppable consistency. Your account balance, at a historically average return, is approximately $637,000, built entirely from a $100 monthly habit that almost everyone else thought was way too small to even matter. Let's break down this final math because it's mind-blowing. Across 40 years, your total out-of-pocket contributions were just $48,000. The final balance is $637,000. That means an astonishing $589,000 was generated purely by time, compounding, and your absolute refusal to stop. Every single month that felt like nothing, every transfer nobody congratulated you for, it all stacked up right here. You know, this entire journey really boils down to a massive clash of mindsets, small and consistent versus large and eventual. Most people are tragically waiting for large and eventual. They're sitting around waiting for the bigger paycheck, the perfect bonus, the magical moment when they finally have enough extra cash to make investing worth it. But that moment, it rarely comes. And while they wait, the person who chose small and consistent quietly secures 40 years of compounding and a permanent relationship with discipline.
Because here is the ultimate truth. Time does not wait for the right amount. It runs on whatever you give it. If you give it nothing, it compounds nothing. If you give it $100 a month for 40 years, it gives you back proof. It gives you proof that the smallest version of the right decision, repeated endlessly without stopping, becomes something that looks exactly like luck to the outside world, but you know it is absolutely nothing but pure discipline from the inside.
So, this brings us to the only question that actually matters. Will you step away from waiting for the perfect moment? Will you finally stop waiting for large and eventual? The machine is sitting right there, ready to run on whatever you give it. Will you make that $100 transfer today and start the machine?